kind of the most genius thing to do as an investor is to know what you don't know and kind of take the counterintuitive position of realizing that average returns are really easy to get and above average returns, slightly above average returns, are incredibly hard to get and almost no one gets them. That is a very odd thing at play here.
Yeah, and you're introducing a whole bunch of risk that you're going to get below average returns by trying to get above average returns. And you're much more likely to get below average returns. I think it's the overconfidence. People want to believe that there's a smart person out there or that they're the smart person that can give them a performance. But yeah, it's not very well supported.
Okay, so I got another question for you, which is I hear about AI, hot topic, robots, hot topic. I want to screw the total market index. I want to put my money in the roll the dice in the AI funds, in the whatever. Why is that a bad idea? Or a good idea? Is it a good idea?
So I got a lot of questions about this when ARK, Cathie Wood's fund or funds were doing really, really well. Like there were a couple of years or a few years where they were just crazy rocket ships, crushing. And so I started getting questions like, why would we invest? Because her narrative was the index has all these old, boring companies that really suck and they're not innovative, and we're going to pick the innovative ones that are going to do really well. So I started getting questions from clients like, why wouldn't we? Why would we want to invest in these old companies? Why wouldn't we want to invest in the new economy? So I did a lot of work digging into that. I made a couple of videos on it, on investing in technological revolutions. I did one on superstar fund managers or something like that too, which those two things often go hand in hand. So what tends to happen? Why is investing in revolutionary technologies or new economy stocks historically a losing game? It comes back to asset pricing. So when something's really exciting, so AI, for example, I think crypto went through this too. Marijuana stocks went through it too. Electric vehicles, I mean, it's just recent history, but this is something that happens throughout history. Railway stocks went through this too. So what happens is people realize this thing is exciting. They realize it's going to be impactful, and asset prices start to reflect that. And so the asset prices shoot up. And what happens when asset prices shoot up? More people hear about this thing. Oh, AI, it's going to be really big. And the stock prices just went up a bunch, so more people invest in it. And the price keeps going up. And that cycle carries on for a while. And you see asset prices go up, up, up. Investors tend to buy after they've gone up. And then they tend to come back down because nothing tends to be as revolutionary as quickly as I think people expect.
And you have a dilutive factor, don't you? Like the companies also are issuing a bunch of new shares. You're not capturing the full profits of that sector that you think you are.
Yeah, that's one of my favorite pieces of this whole thing. So you get high asset prices. And one of the reasons that they're high, I've heard someone call this the big market delusion, which is basically that every stock is priced as if they're going to capture all of the market share of that new industry. But that's never what happens. So even if there is a massive amount of new earnings that are going to be available for an industry to capture, when it's a new exciting industry, like you said, a lot of companies are going to issue new stock, a lot of new companies are going to be created. And so there's this huge earnings pie, but it's not one company capturing it. And the more companies that go after that huge earnings pie, the lower the earnings per share, which is what matters to investors, which is what matters for stock prices, is going to be. And so you can end up with massive earnings growth for a new industry and really bad earnings per share growth for all the companies that are issuing stock to try and capture that new opportunity. And so investors end up just kind of getting hosed. And this is like, you go back through history, this happens again and again and again. High stock prices, exciting technology, investors buy at the peak and they get smoked.
This is what is so interesting to me about finances. There are all these traps for otherwise smart people to make catastrophic mistakes with their finances because of things that seem intuitive until you know a bit more of the picture. Like, I have a guy, I won't say his name, but a very, popular finance guy on YouTube. And he's telling me behind the scenes, oh, you got to invest in, this smart, industry and da-da-da-da-da. And he was making the case so strongly to me that I was like, what is the research on emerging market, like some of these really, interesting industries? And that's when I found your video and I was like, oh, this is not the easy buy that I thought it was, where it's just buy a few of these, hot AI stocks or hot robot. It's going to be the future. It's not as simple as I identified, as if everyone can't see that AI and robots are going to be an important part of the future anyway, to say nothing of that. I want to touch on an interesting piece, which is that even though we all know past performance is no indicator of future, results, we all kind of behave a little bit differently than that. Everyone sort of behaves as if the opposite is true. And I want to talk about US versus international, right? This is a big conversation where the US has sort of, especially in the past decade or so, has sort of crushed. And so there is a narrative that crops up every time something like this happens, which is, well, I just want to abandon this loser, which is everybody else but the US. US number one. We're the kings. Sorry, Canada. You guys are, Sorry, you're not performing. I'm dumping the loser from my portfolio. In theory, intuitively, like if you just didn't know anything else, there's some tendency to believe that idea. Can you explain why this might be a problem and explain the trend of U.S. assets to have become higher priced PE-wise relative to other international assets? AKA, is investing in international stocks a dumb idea?
Since Thursday, I have arrived here well.
At first, I was not allowed to write.
Yeah. So the U.S. market has been wild for the last 15 years. It's been just, insane. Incredible, insane. Yeah. Like anyone that was not investing in the U.S. over that period, like you missed out on a lot of returns, and you don't get those back. Like that's it. Which is one of the reasons that, even though we're about to talk about U.S. expected returns maybe being a little lower than the past, I don't think that means anybody should get out of the U.S. market, because right. I could have said the same thing 5 years ago, and here we are. The U.S. market has been incredible. So what has happened over the last 15 years, but really over the last 30 or so years, is that U.S. stock prices have gotten higher relative to their fundamentals. The fundamentals have been good. Like there's no question there. The U.S. market is objectively strong economically. But the other thing that's happened is the valuations of U.S. stocks have gotten higher and higher and higher. And right now, if you look at the Shiller price earnings ratio, which is one way to measure stock market valuations, it's not as high as it was in the year 2000, but
it's really high, Ben. It's really high.
It's about as close as it's been since the year 2000. And, it's not conclusive by any means, but typically when stock prices are high, expected future returns are low and realized future returns are low. Like if you go and sort historical U.S. market returns by their starting CAPE, their starting cyclically adjusted price earnings ratio, higher starting CAPEs are associated.
Explain what you just said. What's a CAPE? I'm sorry. Sorry.
Cyclically adjusted price earnings ratio. So it's a way of measuring stock market valuations. It's the 10-year smoothed real earnings of companies. Yeah. So you're measuring the prices relative to that smoothed earnings figure, and that just helps to balance out big changes in earnings from year to year. And so that measure is really high right now, meaning buying their starting cyclically adjusted price earnings ratio, higher starting CAPEs are associated.
Explain what you just said. What's a CAPE? I'm sorry.
Sorry. Cyclically adjusted price earnings ratio. So it's a way of measuring stock market valuations. It's the 10-year smoothed real earnings of companies. Yeah. So you're measuring the prices relative to that smoothed earnings figure, and that just helps to balance out big changes in earnings from year to year. And so that measure is really high right now, meaning buying $1 of earnings of U.S. company earnings is really expensive right now compared to history. And historically, that had been associated with lower future returns. Now, what does this mean does international investing make sense? If you look back to 1980 or so, up until now, a huge portion, the U.S. has completely obliterated international stocks over that period. And a huge portion of that difference has come from rising valuations. And so we think about, is the same thing going to happen for the next 20 years, for the next 30 years? It's really hard to say that U.S. valuations are going to keep going up the way that they have over the last 15 or so years to deliver the type of returns that people might expect when they say, oh, I'm only going to invest in U.S. stocks. So I think that's a little bit of a trap. Currently expected returns are low. They're low partially because past returns have been high, which has led to increasing valuations. And so people see the past returns and they project that into the future. But in reality, they should probably, if anything, be expecting the opposite, lower returns. Now, if we look at U.S. versus international stocks throughout history, I looked at this a while ago. I looked at 10-year rolling periods from, I think, 1900 to 2023 or something like that. And it was about 60% of the time that U.S. beat international, which is like, it won most of the time, but it wasn't all the time by any means.
It wasn't what you'd expect if you were only alive from 2010 or something.
That's right. So yeah, I think international diversification makes sense. I made a video on it. I diversify internationally. The U.S. is only one part of the world. It currently makes up about 65% of the global stock market, which is a lot. It's increased each year, partially because valuations have been going up and up. But there's a huge portion of the global stock market that is not the U.S. And the U.S., I don't think, will perform the way it has in recent history forever. And historically, when the U.S. has faltered, when it's had lower returns, international returns have been better, relatively speaking. And that's diversification. It's like basic.
This is another way to diversify. It's just interesting because people who talk about diversification, especially in the U.S., are usually talking about U.S. equity diversification. And they're not actually, they don't want to diversify to the rest of the world. They actually want to bet on their country. There's a bit of a country preference of, and we have historical returns. We look back and we go, see, look, we proved it. We're the best. We want to. But it is interesting, like the same. I find this interesting because I follow some of these. There's this community called the Bogleheads. Have you heard of these guys?
Oh, I've heard of them. Yep.
These Bogleheads. They're like people who more or less subscribe to the theories of Jack Bogle, the Vanguard kind of father of index investing. And I don't want to treat them all as a monolith, but some of them have issues with this idea of international. Like most of them are like, look, even people who, in theory, completely subscribe to the idea of diversification sort of have subscribed to it because they go, look, I don't want to really hold that much. I backtested this and I'm a little smart. And I found out that, international is not worth holding, so I'm fully U.S. And then Jack Bogle even himself is like, I don't hold any international. I hold, and max 20%, something like that. So if we are looking at this from what I wanted to give my audience is no advice, just a theoretical understanding, a framework for how to think about this. In my mind, this is an irrational side of both Jack Bogle's philosophy and in the philosophy of a lot of people who even subscribe to diversification. If you really subscribe to it, you kind of have to subscribe full send unless you're making arguments about like tax efficiency of international, I guess. But what is your thought about that? Do you think that the most sound theoretical framework is just buy everything? And if that's true, do you buy more than just equities? Do you buy commodities? Do you buy oil? Yeah. What is your answer?
Yeah. So I think on the international diversification piece, if someone wanted to be only U.S. equity, it's probably not the end of the world. I don't think it's a good decision, but there are worse countries to invest 100% of your wealth in. Like the U.S. it's 65% of the global market, and it has companies that do have exposure to markets all around the world.
Right.
It's not quite globally diversified because U.S. companies that sell overseas are going to perform differently than companies overseas. So it's not perfect. But again, if you wanted to invest in one country, the U.S. is probably the way to do it. I do also think for U.S. investors, like you mentioned tax, there's also currency issues, costs, that there are reasons to have home country bias. If you're in the U.S. or elsewhere, like in Canada, many people have home country bias, and I think to an extent that can make sense just because of the frictions of owning foreign stocks. There's other weird stuff too that you can start thinking about, like the risk of expropriation by foreign governments in times of conflict. Like those are real things that are worth considering and thinking about diversification. Mm-hmm. So I don't think it's the end of the world if a US-based investor said, I'm going to invest everything in US stocks. I'm not recommending that or suggesting it, and I've argued against that, including with the Bogleheads community many times. Every time I make a video on international diversification, they lose their minds.
Yeah.
Yeah.
Hey,
So
by the way, I like those guys. I like them. I'm not hating. I think they're one of the more sound, financial groups out there, actually. But and they have, interesting discussions. But it is something that's cropped up that I think is interesting because I'm like, wow, this knowing the theoretical underpinnings and actually believing in it when you have all this data that kind of pushes you towards, well, the U.S. seems so good, is hard to. It's kind of hard to argue against the past performance of a guy who's like, I invested in the U.S. in the last 40 years, and everyone who invested in international is an idiot compared to me. And like, in theory,
it's true.
Not in theory, but I guess in practice, he's right. In those 40 years, he was correct. Just like if you invested in Nvidia for the last 10 years, and I'm going to come to you and say, hey, you shouldn't have done that, and they would say, well, in theory, you're right. In practice, you're wrong.
Yeah. I think there's a little bit of rear view mirror bias because the U.S. market has done so well in recent history. But you go back, like from 2000 to 2010, U.S. stocks returned 0 for 10 years. It's like those periods happen, and over that period, other stocks elsewhere did better. I mean, even in the U.S., I don't know if we're going to talk about this, but even in the U.S. market, which is what everybody sees the past performance of right now, was flat. U.S. small cap value stocks over that 2010 period did incredibly well. That's not quite diversification. That's not like an appropriate term for it. But investing in something other than the U.S. market capitalization weighted index can make a lot of sense in some cases. The theory piece of that is pretty simple. If markets are efficient, the global portfolio of assets is the theoretically optimal portfolio. And it's pretty simple. That's the basic argument for why you should be globally diversified.
Okay, question on top of that, because you say that, Ben. You say that, but you don't do that. You don't do that in your own life. You do a little thing called the slice and the factor tilt.
Yeah.
What are the, I've done my research. I've done my homework. What are the factors in the FAMA French model? What is the FAMA? Let's back up. Who's FAMA? And does he know French? And what are these things?
I think we have to back up even further, actually. I think we have to go back one step further to...
This is for idiots, Ben.
Yeah, we're going for idiots. Yeah, I'm gonna do my best here. So we talked about market risk earlier. You can diversify everything away, and you end up with market risk, and that's the one priced risk. That's the risk you expect compensation for taking.
Okay.
And you get that by owning an index fund, a total market index fund. So that idea really comes from a 1964 paper in the Journal of Finance by a guy named Bill Sharp, who won the Nobel Memorial Prize in Economic Sciences for this work. He came up with this thing called the capital asset pricing model, the CAPM. And this model basically predicts, I hope this is not too nerdy, but it basically predicts that expected returns are explained by exposure to market risk. So you take on market risk, you get an expected return. If you take on more market risk by owning stocks that have a higher market beta, that's pretty nerdy talk, but riskier stocks should have higher expected returns in his model. But it's a single factor model, meaning market risk is the only risk that explains expected returns. So that's 1964. From then until the 90s, there were a whole bunch of things that were violating that model. So there were a whole bunch of types of stocks where if you looked at their CAPM, if you analyze them through the lens of the CAPM, it looked like they had higher returns that were too high for the amount of market risk that they were exposed to. So that could mean two things. It could mean markets are inefficient and that there are all these profit opportunities, these risk-free profit opportunities for people to take. Or it could mean that the capital asset pricing model was not the best model to explain how assets are priced, to explain what risks are incorporated into stock prices. So this is where Fama and French. Fama is the guy who came up with the idea of market efficiency in the 1960s and 70s. And his co-author, Ken French, they came up with the idea that maybe there are more than the one market risk. Maybe there's more than one risk that investors care about when they price assets. Because the CAPM was empirically wrong, meaning you could find lots of places where it was not working.
Yeah.
So they came up with this a three-factor model where they said, it looks like investors probably care about market risk, but also the specific risk of small stocks and the specific risk of value stocks. And those are two of those empirical irregularities. Is this dumb enough? I don't know. Like we'd be in.
No, yeah, this is fine. No,
okay.
You want to explain value versus growth real quick?
Yeah. Okay. So value, the way that Fama and French measure it, they measure price relative to book value. So the book value is like just the value of a company's assets. And then its price is the value of its assets plus the discounted value of future cash flows. So basically, if people think a company's going to do really badly in the future, it might trade at its book value. Like this company's going to generate no profits. It really sucks.
Right.
If a company's going to do really well, it's going to have a really high price relative to its book value. So a growth stock would be a high price relative to book value stock. A value stock is a cheap stock. It's got a low price relative to its book value. So they had observed that value stocks tended to beat growth stocks over time. Likewise, they'd observed that small companies measured by their market capitalization had tended to outperform big companies. So they added these two independent factors to the asset pricing model. And all of a sudden, a lot of those empirical irregularities that the CAPM was failing to explain, they kind of went away. So from that paper, this whole field of financial economics was born called multi-factor asset pricing, which is really the study of like how are assets priced, what information goes into the price of a stock, what do investors care about. So they had that three-factor model, and they later in 2015 came out with a five-factor model.
Let's not talk about the five. Let's stick with the now. For now.
Yeah, the three-factor model is really it explains the CAPM explained like 2/3 of the differences in returns between diversified portfolios. The three-factor model brought that up to about 90%. That means like if you take two actively managed portfolios, for example, and ask why are their returns different, the CAPM is going to explain about 2/3 of it. The three-factor model is going to explain about 90% of it. The five-factor model explains about 95%. So there's definitely some diminishing returns.
That is to say, their returns are explainable as a function of the amount of risk they're taking on.
That is fundamentally the whole idea is exactly that. Yeah.
So, because this is something that was confusing me when I first learned about this, is I was like, oh, are the factors like another way like diversification to get sort of this free lunch? Like I just buy more small cap index funds and I buy more value stocks and I just get better returns as opposed to people who buy the whole market index. Is that what you're saying?
Well, theoretically, they are independent risks that a lot of investors probably should not be taking. And that is why they're compensated. So the market portfolio, in theory, the market capitalization weighted, like you go and buy the market index fund, that's the optimal portfolio for the average investor. Now, if you're not the average investor, if you're in a position to take more risk than the average investor and take more risks that show up at really bad times than the average investor, like risks that will show up at the same time that you might lose your job, somebody who has a job that's exposed to those types of risks, they maybe shouldn't be investing in value stocks. Mm-hmm. Someone who's retired, for example, and doesn't depend on their income at all, maybe they can take a little bit more risk by tilting toward value stocks. But they're not for everybody, and they are risk, at least in the Fama French thinking, they're risk premiums, which means like, no, it's not a free lunch. It's an additional risk that you're taking, and doing it can suck. Like if you were investing in value or small cap value stocks over this recent period where the US market's been going nuts, it hurt. Like I have a value tilt in my portfolio and it sucks.
Yeah, because growth actually has been, value doesn't always beat growth, and growth has been killing.
Yeah.
Anyway, I wanted to kind of bring that up because it's an interesting, deep dive on the specifics of, diversification. People talk about these factor tilts. They're not talking about the same thing as diversification where you get sort of an increase in expected returns for no additional risk. You are getting an increase in expected returns for taking more risk. Just like if you were to have, 100% equities versus having 80-20 bonds or something like that, you would expect more return, but you're taking on more total risk. I think probably we should touch on bonds a little bit. Everyone kind of is bored to death by bonds. But for the first time ever, they've become a little bit interesting. Well, at least the first time in sort of my investing lifetime, where they're actually paying something. How do you think about bonds in somebody's portfolio? So far, we've just been talking about equities, but that is not sort of the commonly understood way to invest, because if you want to diversify, you should also be thinking about diversifying away from just pure market risk as well, depending on how much risk you want to take. What is the kind of theory behind why someone should consider bonds in their portfolio? What are they? Maybe just jump into that.
Sure. So stocks are pieces of equity ownership in a company. You're participating in the expected future earnings of a business. And because of that, they can fluctuate a lot. Businesses can have bad times. And so stock investors are exposed to a lot of risk. So that's investing in a company stock. There are also these things called bonds, which is another way for companies to raise capital. If they don't want to issue stock, they can issue bonds. And they're effectively borrowing money. So if you buy a bond, you're kind of lending money to a company or to a government or whatever, and they're going to pay you interest. They're called coupon payments. And then at the end of when it matures, they're going to give you your principal back. The other interesting thing is that if a company goes bust, stockholders usually get zero. But bondholders often have some claim on assets. So there's a couple of different reasons there. Like you've got guaranteed payments, you've got principal at maturity, and you've got potential claim on assets in a worst case scenario. So all of that together suggests that bonds are a little bit safer than stocks, which, is more complicated than that, but that's kind of step one. They're a little bit safer.
Yeah, I want to talk about what is risk later.
Yeah.
If you have time. I don't want to take too much of your time, but okay. The point is a little bit lower downside. In theory, bonds have a lower downside risk of losing money, especially when you talk about what a lot of people are thinking of when they think of bonds, at least for their investment portfolio, is some type of government bonds or high-grade bonds. For a while, the U.S. especially has been in an odd position. I don't know the interest rate situation around the world, but the U.S. was in the interesting position of paying very little for bonds. So there was, what's sometimes known as like the risk-free rate for the least risky thing we can think of is like sort of what the government going bust. So the closest thing to risk-free as you can get was basically nil. I mean, nearly nil. So how should people think of bonds? And there's long-term bonds, there's short-term bonds, there's medium-term bonds. Ironically, these have different types of risk, because when I first understood bonds, I was like, oh, well, the long-term seemed the safest. Get a 30-year bond, you're guaranteed to have that payment for, like, what's the risk? Can you explain the different types of risk of short, medium, long-term bonds?
Yeah, really interesting question. No, it's a great question. It's not an investing for idiots question, but I love it. But I love the question. Okay. So shorter maturity bonds are going to be really low in volatility. So volatility is like the price can change. If you buy a short or treasury bill, for example, like it's basically like cash. Like you're going to earn some interest. It's not going to move around. The price is not going to move around. As you go longer out in maturity, the price is going to move around more and more day to day based on changes in things like interest rates.
Break that down, because if I buy a 30-year bond today at 5%, just so everyone's clear, I will if I wait the full 30 years. The price doesn't fluctuate and the interest rates don't fluctuate. So why are you saying that the price fluctuates?
If all of a sudden tomorrow, so you've got a bond that's paying you 5%. If all of a sudden tomorrow I can go and get a bond for 6%, your bond is going to be worth relatively less in the market. So it'll be repriced based on what the new rates are. And if you went to sell it, you're not going to get your principal back. So, and because assets are priced daily, you're going to see a price fluctuation. The longer you go out in maturity, the more extreme those price fluctuations are going to be. So at like the 30-year mark, they can be extremely volatile. But now back to your question, what is risk? So for short maturity bonds, you're not going to have any volatility, which is one way to think about risk. You're also going to have a relatively low interest rate. And if you look in the data around the world for how to build like very short-term government debt obligations, how do they perform? There's a pretty good chance you're going to lose money in real terms holding very short-term debt. So they're not volatile, but there's a good chance they won't keep up with inflation. So you're not taking on volatility risk, but you're taking on the risk of losing your purchasing power. If we go to the other end of the spectrum, it's nominal bonds that we're talking about. So bonds that don't adjust for inflation. There are also real bonds or TIPS in the States that do adjust for inflation.
Keep them out. This is an idiot's class.
It's hard to ignore them. So I'll talk though about long-term bonds. Like you mentioned earlier, if you have a nominal liability, and that's important, it's frustratingly complicated, but it's important. If you have a nominal, so it's $100,000, but it's $100,000 nominal, so it's not going to change in real terms. Like there's no inflation on this liability that you have.
Right.
And you buy a bond for that, you're going to get your interest over time, and you're going to get your principal back at maturity. And even the price fluctuations in the interim are not going to matter to you because you have this 30-year liability that you need to fund, and you don't care about the interim. So it's going to be volatile, but it's going to hedge your future liability. The problem is most liabilities are not nominal. Like, I don't think an individual house, like you or I do not have nominal liabilities, I don't think in anything. Like there's nothing that I'm going to want to buy in the future that's not exposed to inflation. Insurance companies have nominal liabilities. If someone buys $1 million insurance policy, it's going to be $1 million insurance policy in 30 years or whatever. But we households, people want to buy stuff, food, whatever. Those are real liabilities. So a nominal bond, even if it perfectly hedges a nominal liability, can be extremely risky in real terms. And so this gets to the really interesting thing. But now you can buy an inflation protected bond to hedge that real liability. But bonds more generally, nominal bonds, how do they fit into portfolios? They reduce your volatility for sure. Adding bonds to your stocks reduces your volatility. But they probably decrease your ability to maintain purchasing power in the long run. And so
we should first we need to probably define what volatility is, even though we've been talking about it for a while, because most of us, myself included, I usually think of risk just in terms of volatility. Like, the risk that price will go up or down and the size of those swings. But that is not all that risk is. Risk is actually very hard to define. Anyway, go ahead. What's volatility?
It's the price, how much, the magnitude of price changes, I guess, is one way to think about it. So a stock is going to be volatile. It's going to be worth, $10 today, but it might be worth $15 tomorrow or $5 tomorrow.
Bitcoin is volatile. Bitcoin one day it's worth 10,000, one day it's worth 100,000. And then as compared to that, we talk about bonds as being less risky. What do we mean by that? We mean they are going to be subject to lower price fluctuations. But that, as you say, is not the only risk. A huge risk that we, all are concerned with is, okay, in 30, 50, 80 years, when I need to fund some retirement, do I have enough money as relative to my standard of living and the inflation that has happened during that period of time? That is a huge risk and there is an argument, maybe you could give it, that having equities as part of your portfolio actually de-risks that.
Yeah. So equities are very risky in the sense that they're volatile and they do have an uncertain long-term outcome. Like there's no sane world where I would say that investing in stocks is going to give you a guaranteed inflation-adjusted return in the long run. There's still a chance you lose money. But relative to nominal bonds, stocks have historically been much safer. There's a paper on this that's not published yet. It's going through like the conference cycle and stuff. And it's getting interesting comments. I've been talking to the author about it the whole time, but the paper's called Challenging the Status Quo. And it's basically saying that the status quo is that people think they should start out investing in stocks when they're younger and then add bonds as they get older because bonds are safer. And that's like, common sense.
Textbook.
Right.
Yeah. And
so their paper basically shows if you go and look at they use global data going back to 1870, and they did something called bootstrap simulations. Basically, they created a whole bunch of hypothetical scenarios using actual historical data. But it gave them way more potential hypothetical scenarios based on historical data than we actually have historical data.
Right.
And what they found in those simulations is that the optimal portfolio for the whole life cycle is 100% stocks. Now, this is it's pretty controversial because while their data show that, a lot of people get really upset that anybody would possibly say that, but it's at the very least, it's a very interesting finding. And it's driven by the fact that stocks are still very risky. And they emphasize this in the paper. Stocks are still super risky at long horizons, but bonds, nominal bonds, are a lot riskier. You're much more likely to lose money in bonds. And so adding them to your portfolio, adding them to your portfolio makes it riskier. It makes it less volatile, which is great if you're really worried about volatility, but it makes it riskier from the perspective of funding your future consumption.
Okay. That being said, one thing that always freaks me out about things like that, and maybe this is the slightly risk averse volatility wise guy in me, which is that every financial investor can read all the theory till they're kind of blue in the face, but they only get one shot at the financial markets and they can't predict beforehand what their ride is going to be. So they have all this history, but they're guaranteed a different ride than that historically was the case. So saying historically we had all this, evidence that, stocks or whatever, stocks don't always beat bonds. Now they beat bonds over, if you take a long enough time frame, you could say that they beat them over, this many, if you take this many years, but we also don't know that that's even a guarantee that that will continue to be the case. So what always, freaks me out about that is you have to plan for what historically didn't happen to happen. And that is to me, the basis of a sound framework for investing is you have to build a portfolio where, yes, you want U.S. stocks to rip 100, for the rest of time, but you have to plan for the event that doesn't happen because you only have one shot at your investing time period. Does that make sense?
It does make sense. And I mean, there are different ways that people have tried to express that. I've seen some pretty crazy portfolios that take what you're saying to the extreme, where it's like, we're going to have 10% gold, 10% stocks, 10% Bitcoin, like every possible thing that's going to perform potentially differently from the other stuff. So I don't disagree with you. And bonds are a pretty tame example of diversification, obviously. And I'm not advocating for 100% stock portfolios. We have not very many clients at our firm that are actually invested that way. I think it's an interesting idea. But yeah, I mean, there are limits to that thinking. We don't know the distribution of all future asset returns. And because of that, we don't know which assets are going to be good diversifiers. I think looking at historical data is one interesting lens, but I agree with you. Like, if you look at just the theory and forget about that empirical paper, yeah, of course bonds make sense. But then you look at the empirical paper and it's like, well.
Yeah, okay. This gets me to actually where I want to sort of try to start wrapping things up, which is through listening to the Boggles, to the Ben Felixes of the world, to all you smart guys who are reading all these papers, I've sort of come to an interesting place where the fundamentals are sort of undisputed in a lot of these circles, where it's like, okay, passive investing, you get what you don't pay for. Most active investors will lose, so the average makes sense. And then it's almost like when you get into like the basics of fitness and then you get into advanced fitness, where there's all these new papers that come out and people excitedly rush into these like new theories about like how to optimize the, you know, the little tidbits of this or that. But they are sort of making tiny little, I would say like a you know, theoretical, I don't know, bets is the right word. I guess in finance it's a little bit more of bets because you don't know the outcome. But ultimately, when you do think about people who are not plugged in, what do you think about, this is, I guess, where we're going to end where we started, which is what should most investors, okay, that they're not reading journals, they don't want to pay attention to any of this stuff, they don't want to be worried about, you know, sort of what the latest paper says about allocation. What is like the basics? And then we can't tell them what portfolio to build because obviously they need to make their own decision based on that. But let's get back to ignoring like the daily trends of, or I know it's not daily, but like the year to year, decade to decade trends of, you know, we think this is interesting, this is, you know, a slightly better way to do it. What is the, not advice, but framework for most people to think about investing? Going back to For Idiots.
So let me give you an interesting example. We talked about factors. We talked about the Fama-French 3-factor model. We didn't get to the 5-factor model, and that's okay. But there's this term that's been created in academic finance called the factor zoo. And that term was created because there were so many documented factors. There were so many, they're called pricing anomalies, like so many observations that this type of stock or that type of stock did better than other models would predict. And for the exact reason that you're saying, that is a problem for someone who's trying to optimize down to the most recent paper. So I don't think that anybody should be doing that. The problem that creates for people who want to pursue factor investing is that there's always competing models. So the Fama and French have a model, but there's a ton of other models out there. And a lot of people say now that, well, the Fama French model is no longer relevant because of this, this, and this. So if you're a Fama French value investor, it's really hard to stick with your value portfolio when it's underperforming. And people are saying, well, no, Fama and French are wrong now because of this, this, and this. You should be using this factor model. So for most people who don't want to get into the details of why they think Fama and French are still right, they should probably not pursue that type of investing. Now, some people can do it. Like we have an online community for our podcast called the Rational Reminder Community, named after our podcast. There's a bunch of people in there that like, it blows my mind, honestly. I love that community and I interact in there often, but there are people in there that literally nerd out all day, spend hours in there talking about, you know, value should be defined this way. No, it should be this way. Or like momentum is a good factor or no, it's not. So some people love that. And I mean, I think that those people probably treat it like a hobby. That is not most people. The Rational Reminder Community is not most people. So I think for someone who's listening, for the Investing for Idiots listener, the intended consumer of this podcast, they should probably be using low-cost index funds that just track the market. Now, whether that's US or globally diversified, I don't know, man. Like there's funds like VT. That's not a recommendation, but that's an all-stock global portfolio. That's a pretty nice security as a starting point, at least on the equity side of a portfolio. One thing, you don't have to think about it, you don't have to worry about it. In Canada, we have similar products called asset allocation ETFs. They're not quite like VT because they give an overweight to Canadian stocks. They're not market cap weight, but same idea. One thing, and you buy that and that's your portfolio. I think that level of simplicity, like we talked about investor behavior earlier too, and when you look at the data on that, funds that are self-contained, that rebalance themselves, they tend to have much lower behavior gaps. Investors tend to behave much better in those products. So for the typical person that's listening to this podcast, that's like trying to learn about investing and they want to just make good decisions, total market index funds, market capitalization weights are a great starting point. And the more simple you can make it, the better you're going to be in the long run.
And if I could humbly add one tiny thing to your great wrap up there. Low fees. We didn't really touch too much on like, because ETFs and mutual funds have their own set of fees involved. You need to pay attention to that and keep it as low as possible. Ben Felix, you have been a fascinating character for me to learn from, and I really appreciate you coming on the show. Where can people find you? Obviously, you have the Rational Reminder podcast, and you have the YouTube channel. Is that your main two outlets where people can discover your work?
Yeah, I release videos every 2 weeks on my YouTube channel, and then you just search Ben Felix, I guess, on YouTube, and you'll find my channel. And then Rational Reminder, we post an episode every week. Those are they're pretty nerdy. I mean, if people want to be really get into the weeds, I guess that they can listen. But I mean, yeah, investing for idiots is not Rational Reminder's intended audience.
Yeah, and that's not a bad. That's fine. These are our meme coin investors, our Wall Street bets guys. Okay, thank you for watching. We'll see you next time.